Welcome back for class number 18. In our last class, we introduced investment funds, which allow us to buy a small piece of a wide range of investments all at once. We also learned about a special type of investment fund called a mutual fund. This type of fund is primarily used for investing through retirement savings accounts, such as 401k plans. In addition, we learned that a fund has a manager that sets the investment strategy for the fund. Investment strategies come in all shapes and sizes, and we even learned some basic strategies. In this class, we're going to continue our discussion by learning two basic types of approaches that a fund manager can use. But before we do, you might ask, what's the difference between a fund strategy and a fund approach? They are similar, but think of an approach as more general than the many strategies we learned in our last class. The first type of approach is called an actively managed approach. In this approach, a fund manager picks and chooses which individual investments they want in the fund. The manager takes this approach because they think they can provide superior returns to investors. A manager will use research, experience, and judgment in an attempt to predict which investments will do best over time. We call this the crystal ball approach. The manager is literally attempting to see into the future and buy the investments that will bring the highest returns within the particular strategy that the manager has chosen to pursue. For instance, let's say a fund manager uses an actively managed approach and their strategy is to buy high growth small cap companies in the technology sector. The manager will do research and buy those stocks in smaller tech companies that they think have the best chance to provide high returns in the future. Let's pause there for the actively managed approach, and we'll explain it more in a few minutes. The second type of approach is called a passively managed approach. In this approach, a fund manager does not believe they have an edge in picking individual investments, nor do they believe they can see into the future to provide superior returns. The primary example of a passively managed approach is called an indexed approach. Don't worry, that may sound like alphabet soup, but it's not difficult at all to understand. I also realize that this is probably very new for most of you. If you don't feel comfortable with the material by the end of this video, take another pass through it. An indexed approach is a passively managed investment approach that attempts to provide the same returns as an index. What's an index? Well, an index is basically a numerical calculation that attempts to measure the price level of an entire basket of assets. Let's say we wanted to measure the price of not just one stock, but the price of a whole wide range of stocks. We can use an index to do this. One of the most widely known indices, that's plural for index for you non-English majors, is called the S&P 500. The S&P 500 measures the price of 500 of the largest publicly traded companies in the US. Think of the biggest companies: Amazon, Walmart, McDonald's, JP Morgan, Ford. Chances are, if you think of a big company in the United States, it probably falls in the S&P 500. What this index does is attempt to capture what a very large cross-section of public companies is worth. One reason why the S&P 500 is so popular is because over long periods of time, think 20 or 30 years, the S&P 500 companies overall have provided excellent returns. We'll talk more about indices like the S&P 500 in a future class. But for now, just know that a passively managed indexed approach is used by a fund manager to track the returns of an index very, very closely. The S&P 500 is far from the only index, and not all indices are as diversified as the S&P 500, but a few are even more diversified. In addition, it's also important to note that there are indices for bonds, real estate, and many other assets. This is called a passively managed approach because the manager is not trying to make their own decisions about which investments will do best. They just buy investments so that the fund's performance matches the performance of the particular index as closely as possible. Okay, so we have actively managed approaches and passively managed indexed approaches. Naturally, you probably want to know which one is better. Well, the answer to that question depends on the skill of the individual manager and whether that manager can consistently outperform the benchmark index. This is also called beating the index, or more commonly, beating the market. There are many studies out there on what percentage of actively managed funds outperform the market, and those percentages depend on the investment horizon or time frame that the study is analyzing, and also the investment strategy that the manager is pursuing. However, several reliable studies tell us that over 20-year investment periods, actively managed stock funds have failed to beat the market over 90% of the time, net of the fees charged to manage the fund. And the results aren't much better over 10-year or 15-year investment periods. Remember, these are investment professionals managing the funds. To put it plainly, it's not easy to beat the market consistently as an investment professional. It's significantly more difficult to beat the market consistently as a simple retail investor. And it's also very difficult for a retail investor to pick the individual managers who will beat the market consistently. This is why passively managed index funds are so popular with retail investors. For example, instead of trying to pick the winners and losers, retail investors could invest in a well-diversified S&P 500 index fund over a long period of time, and many do. Again, we'll talk more about these indices later and why certain ones like the S&P 500 do so well over time, despite having short periods of doing poorly or even crashing. Okay, before we learn more about how investment funds work, I want to cover a few types of actively managed funds at a high level, so you know what they are if you come across them. The first is called a private equity fund. So far, we've mainly discussed stocks or equity interests in public companies. Well, what about privately held companies that don't trade on a stock exchange? Can I own those? If not, who does own them? Generally speaking, private companies are owned by their founders, individual private investors, and/or private equity funds. A private equity fund is a fund composed mainly of large institutional investors. Think university endowments, pension funds, banks, insurance companies, and very, very rich people who pool their money together into the fund. And the fund goes out and makes investments in privately held companies. Private equity investments tend to give these investors higher returns, but they can also be riskier, have high fees, and have provisions that lock investors in for periods of time. A specific type of private equity fund you may also have heard of is called a venture capital fund. A venture capital fund is a type of private equity fund that focuses on investments in companies that are just starting out, also called startups. These investments can be very risky, but also provide very high payoffs if the underlying companies are successful. Many venture capital investment funds are based near Silicon Valley, California, as many investments are made in high-risk tech startups nearby. Again, these funds are usually limited to large institutional investors. A third kind of actively managed fund is called a hedge fund. A hedge fund uses a wide range of investment instruments and quantitative strategies to provide superior returns to institutional investors. Hedge funds are not very well regulated and are seen as much riskier than actively managed mutual funds. It's important to note that private equity funds, venture capital funds, and hedge funds are not traded on any exchange. Therefore, in order to invest in one, you essentially have to be invited or pitched. Again, it's very unlikely you will be rich enough to invest in one, but it is important to have a general understanding of what they are in case you hear about them along the way. As we mentioned in our last class, fund managers charge a fee to run the investment fund. After all, their manager services aren't free. Generally speaking, fees for passively managed funds are much lower than fees for actively managed funds, since there's a lot less cost to running a passively managed fund like one that tracks an index very closely. This is a benefit of index funds. Personally, I tend to steer away from actively managed funds because I don't believe that I'm skilled enough to pick the few funds or managers that will consistently outperform the index. For most of my stock investments, I am happy with the returns that a low-cost S&P 500 fund provide over time. Again, we'll talk more about this performance in our class on market indices. Let's stop here and let that digest. This is an exceptionally important class, so please feel free to let it sink in and revisit it over the next week to absorb more. In our next class, we'll round out our discussion on investment funds by showing you exactly how fund management fees are calculated and how they reduce our returns. We'll also discuss two more funds. One is called a target date fund, and the other is called an exchange traded fund, or an ETF. We'll discuss exactly what these funds are, what they are used for, and how they fit in with this lesson. Lastly, we'll teach you how to obtain and evaluate a fund prospectus, which is a document that summarizes what a particular fund is, how it's managed, and much more information you might want to know as a potential investor. Don't miss it. If you have any questions at all, I encourage you to contact me at opusmonetequestions@gmail.com or comment below, and I will try my best to get back to you as soon as I can. Thanks for watching. If you found this content to be helpful, I'd like to invite you to hit the subscribe button and give us a like. You can find additional resources, insights, and motivation by following us on Instagram and TikTok. Also, we greatly appreciate your recommendations. If you think this content may help your friends and family, share the wealth and let them know about us. See you all in class number 19. Peace.